You're listening to the Brick by Brick Podcast.
Welcome back to the Brick by Brick Podcast. I am John Erico here as always with Ryan Goldfarb. We are very excited because we have a great episode today with a guest. We don't often have guests recently because of COVID issues, but we have a guest appearing virtually who's actually a friend of mine in the real estate space, Stefan Tsvetkov, who is a data scientist, a quantitative expert, also real estate investor, friend of mine. I met him in the real estate investing context, and we're going to be discussing real estate valuations across the United States and also a little bit of Stefan's background and thoughts on the real estate market in general. Stefan, please introduce yourself, and thank you so much for being on the show.
Yes, thank you guys for having me. Hey, John and Ryan. So my name is Stefan. I'm a financial engineer previously by career and education, and I'm a multifamily investor in the recent couple of years.
Perfect. Stefan, I think before we get into the topic, which is on real estate valuations and your perspectives and thoughts on that, it would be fun just to hear a little bit about your professional background and also a little bit how you got into real estate investing. I know you're doing your own thing right now, but I know you have a kind of a financial background before your current venture. Is that right?
Yes, absolutely. Yes. So first of all, I'm a Eastern European myself, Bulgarian originally. So I came to the States like straight to New York at 22. I came here to do my master's in financial engineering at Columbia, and then I worked for 10 years in the field. So I worked at an insurance company managing the derivatives portfolio of an insurance company. So that was my job for about 10 years. And I recently switched to full-time investing and building analytics, building technology in the real estate industry.
So what did your real estate investing career look like prior to jumping into your current role full-time?
Yes. So prior to jumping into my current role, so I did a few deals in New Jersey and New York State. So I had prior to jump, I had maybe 5 deals or so. So I kind of what I was primarily seeking as an investor, I was looking for sort of turnkey deals that have some kind of arbitrage or inefficiency where you can realize an equity upside. So those are different types. So it's, let's say, a 4-plex, turn it into a 5-plex was one of my deals upstate that sort of doubled the valuation, fortunately there. And then subsequently condominium conversions is what I've been doing more recently. So to your audience, for your audience, so that's taking a multifamily, it could be any number of units and, making it into condominiums. It's sort of a legal side value add. It may involve renovation subsequently, but it was more of my mindset as a finance person was really more, okay, can I have a price discrepancy that is there in as-is condition and work out from there to potential phase 2 other further upside if that's the case, but always my criteria for deal selection were okay, is there some kind of equity gain potential in as-is condition can be realized. So yeah, that's what I was looking for. So I was really impressed.
Sorry, the arbitrage opportunities. So in the case of a condo conversion, I'm guessing that you were finding properties that were not, existing condominium buildings, right? And then you're subdividing the apartments or whatever it is into condos, and that's the arbitrage opportunities. Right? So it's as in the sense that you're not gutting the building necessarily, but you're still putting work presumably into subdividing the building into condos or whatever, right?
Well, yeah. I mean, it's to the extent that if you do only legal side value add, you can say that's work as well, and then okay, maybe it's not perfect arbitrage in that sense, but it's more of the idea being, okay, if you do not have to physically alter the property necessarily, do you have some kind of opportunity with it that has a high certainty of happening, and yes, so definitely multifamilies that are not already condos. But my second deal actually, while I was still having my job, was actually a condo building. So it had 3 condos, so it was already separated. and that was in 2018. But they actually were not able to sell them, so that was kind of like non-warrantable condos strategy where they weren't qualifying for conventional financing. And I was okay. My kind of bet was maybe that may change, and even if it doesn't change, I'm pretty good with finding like good lenders. So maybe I will find like an opportunity for the buyer, and I connect him to a lender who would give him like favorable terms, etc. So that was that had an arbitrage that was perfectly turnkey building. I did nothing to it, and it had an upside of, I don't know, maybe 25% or something like that.
Awesome.
And
So going into these projects, you're looking at it and saying, I can buy this building right now for $400 a square foot. And I know that based on the current market conditions and the current conditions of this building, if this were a condo building, I know that these units would be selling for something like $500 a square foot.
Yes, if it happens to be the case, and doing this kind of with data, and so I would pull like all multifamilies in the New York City area, and actually like for other strategies, because I would go like upstate New York as well. So for other strategies, and then including this one, I would pull maybe 6,000 multifamilies, which most of them would be small multifamilies, 2 to 4 units, and there would be some bigger ones as well. So like about 6,000 on-market listings actually. And I know investors are usually kind of skeptical because it's more of like an off-market strategy, but I was feeling that, okay, if I have like the full data and I'm able to actually kind of price it on a set of criteria, I could go to 0.1% and find some kind of exception. And I believe it does work, and it did work. So most of the deals I did find on the MLS. It's not a popular thing to say, but that's what actually happened. But if you underwrite on this kind of more contrarian strategies that other investors are not looking into, then maybe there is a bigger chance that there isn't too much investor appetite there, and you have like thousands of listings. And but again, like for condo conversions, most of the time it wouldn't be the case. So most of the time there's no real arbitrage. If you look at the condition of the property, you realize, okay, well, yeah, it could be worth more as condos, but maybe it's kind of like when you put in the renovation cost, it kind of evens out, or it's not really an arbitrage opportunity. So it does take certain effort to find, and it's like, very few buildings that actually work for that have the proper layout. And so maybe it's going to be like a 3-family that has a 3-bedroom units or something like that. But that was kind of one strategy.
Well, it's interesting because it's actually not completely dissimilar to our strategy that we do in Atlantic City, Stefan. I think but we're doing value add stuff where we're taking distressed properties and then renovating. But part of it is that we're finding mispriced assets because the sellers are pricing the units or the apartment or the building, not believing they can do short-term rentals in the building, which is extremely lucrative. And we know that we can, so we can buy existing assets at, maybe a fifth of what, say the price should be relative to the income of the property, and potentially do very little. I mean, in our case, we do a lot to them, but potentially do very little and still rent them out for quite a lot. We know other investors who do more of that like turnkey strategy. So it's a great strategy. We found a lot of stuff in the MLS as well.
Yeah, and one added perk to that I think often goes underappreciated is the fact that the MLS is generally more complete in terms of the data that's provided than you'll find anywhere else. So I know there are a lot of people, like including us, who have done a lot off market, and we've done a lot of direct mail and things like that. But when you're buying data or you're procuring data yourself, there's very limited. There's a limited supply of accurate data that you can pull like en masse. Whereas like the way that the MLS is regulated and administered, you get a more complete data set, and if you're able to employ a strategy,
there's just more depth. I agree. You're completely right, Ryan. So, and again, this is not advocating MLS in any way, and that's I would say that primarily works for residential deals, and I think on the commercial side, it's not a good strategy. And there, I can share like what I've been doing, because I'm looking into switching to this field, and maybe did my last residential deal at this point, we'll see. And so I wanted to like kind of like the model that I did in commercial space, I can share, and that there is an off-market model. But for residential, I've really been doing on-market because exactly to your point, there's just more data, there is more depth that you can get out of this data. And even if you say like something like the MLS, I was doing like what I was doing, I wanted to find like, I was going to like online sources that would almost exactly mirror the MLS. Now, this is a question maybe for an internet attorney, whether one should share this here, but such resource is Redfin. So Redfin is kind of like being a brokerage, by virtue of their technology model as compared to Zillow and Truly and Realtor.com. They're just that their data is different. So, like where Realtor.com would take their data from List Hub, you would have a Zillow and, Zillow sort of like in certain like agent submissions, etc. But the data from Redfin would be literally a copy of the MLS without the broker remarks and advertising remarks or whatever, or I guess broker remarks, or what do they call it? So that's so that would like have a lot of depth, and so I would reason, okay, I would only have value if I could use this extremely like deep data and like where you can see like literally the unit split and square feet and stuff like that. So that I think was a kind of it is a viable strategy in the residential space. It's also a lot of work in a way. But I mean, as far as like, let's say to compare to what you guys are doing, I did purchase, I had a couple of deals which were renovation projects, which we sold to other investors upstate New York. Mm-hmm. So those would be like the complete renovation project, but I find it using this data and I would buy like the cheapest 3-family existent and kind of like with all its characteristics, etc. And I would not even go and see it. And I would do an inspection first. And then if it passes the inspection, then maybe I will go see it and before I buy it, and that's pretty much it, and that also went well. So another thing I think I feel on the MLS actually for renovation deals, if one goes to really depressed markets, and we have plenty of them here in the Northeast. So if we, for example, upstate New York, upstate New York is one such area where I feel like it's definitely a buyer's market where you can, even if it's like a turnkey property, you definitely should go and bid 20% below ask at least, and even if it's on the MLS and or 25 or 30, and then typically most sellers would agree to that. But the way I kind of would know that, look, it's so depressed, and I feel that many investors, like I would have like some of my friends from New York City, they would go to an area like that, which is, in my opinion, like super depressed. And so they would go to an area like that, like upstate New York, the majority of counties, let's say, that are with relative proximity to New York City, because there was some growth in like towards the Buffalo area in New York State, mm-hmm. And then obviously New York City, and those were like this market cycle. Those were the growing regions in the state, but everything else pretty much was like super depressed. And so if one looks at the market data, let's say for that, one would see that, okay, if you buy something in the capital region, it primarily, like since its last fair valuation, it didn't appreciate at all. And so it becomes a situation where you definitely want a discount. I'm not gonna pay a market price for something that's not gonna appreciate, and I'm not gonna buy it for cash flow either, because that's a little bit of maybe a rookie strategy, you can say, to buy for cash flow, right? So you want to have some kind of equity upside. So that's that was another strategy. So either like a renovation project, and I have also a 5 unit upstate, which has like amazing cash flow, and cap rate is over 20, I think, and it's actually the genuine cap rate, it seems, like, because there's like almost no repairs, at least so far, and that also had a lot of equity gain, because it just was bought at such a discount, and I was able to pull tax data as well. And let's say tax market values are not a great market value, of course, let's say, but to an extent they are useful data, because like tax authorities, they do try to, it's not the assessment, it's really the assessment times like an equalization rate, so it's meant to be market value. It's not total nonsense. So in that case, like that property, I bought it like close to half of the tax market value, which was outstanding, because actually it was interesting that even if tax market value is kind of irrelevant, most of the properties were trading on the MLS around like within like 5% of the tax market value. So it was, and actually the majority were trading still above it, even in those depressed markets. And so that was like kind of one data strategy to find something that's just discounted, that's not going to appreciate because the market is depressed, but just happens to have like a very strong cash flow and it's fairly turnkey.
When you're looking for stuff in this manner, are you entirely agnostic to the market? I mean, I'm assuming that your algorithm or your search, you're not necessarily saying, I only want to look in upstate, right? These specific cities in upstate New York, or is that what you're doing? Or are you saying I'm just looking at anything, and if it just so happens to be in these certain cities, then that's great?
Right. I mean, you're saying in a sense of like, do I have like the more typical kind of investor focus where you pick a market and you want to work just there? And well, I would say to the extent of if I'm not intending to do any renovation work, then I am somewhat a little bit agnostic, or more agnostic than other people would be or try to be. So I try to, okay, if I'm picking like a project that I can sell to somebody else, like those like renovation projects where you can just buy the renovation project discounted compared to the price of the same renovation project that ought to be, maybe, let's say. And then, so those, you know, I would be pretty agnostic then that they can be, you know, really far upstate, like 8 hours from New York or something. And I don't really care because I'm not even going to see it in person. So just literally just buy it like a stock and kind of resell it. And that's a profitable thing that one can do, just literally finding deals like that with data and reselling them. It's not a super huge margin. And so I honestly don't want too much to bother with it, since you still want to like, you still need to do your inspection and etc. But in theory, one can pick up like, you know, small spreads and accumulate them in a way where you do not need to see the property or renovate it just because you would need to do your inspection and FaceTime view it, of course, and try to get as many data points as possible. But to some extent, you're pretty hands off.
So it sounds like you're using data quite a bit at the micro level, kind of on the asset level, to try to find deals. Do you apply data in the same manner to try to identify markets or to try to gauge the? Okay.
Well, first I do, yes, and that's a good question. And so first, actually, I just wanted to give like a quick summary, if you guys would wow. So I just wanted to give like, to me, like actually what's data-driven investing, because we did mention like this kind of on-market listings kind of analysis, but I just wanted to give like some of the other, I would say this is like the number one, pure call it, let's say. Then a second one to me is, let's say in the commercial space, it would be like off-market modeling of apartment buildings where you want to. So that's, one can do it with rental listings data online, as well as in inventory for those apartment buildings. So that's inventory now can be from Prospect Now, Yardi Matrix, etc. Or it could be also, if one wants to web scrape it online, one could do that, you know, at his own legal risk as well. But basically, if you're able to combine inventory with rental listings data, you sort of have preliminary modeling for thousands and thousands of commercial buildings, where you can model their value add in a way that, okay, you can rank them now, these and these buildings in those markets show the potential that you can have like higher NOI increase and higher value adds to your project. Let's say in the sense of, due to from their rental listings data obtaining information for, okay, are their rents below market? That's the more obvious thing. But then also, are there other income components too? If one takes a resource like CoStarsApartments.com, and I've spoken at this about this at my webinar as well. So they actually have other income components for those buildings. They would have like whether they're charging pet fees, administrative fees, etc. And if a building is, let's say, not optimizing this relative to their neighborhood, you could realize an NOI from that, NOI potential from that, or let's say their utilities, like rental listings, they may say whether they're billing back utilities and things like that, and apartments.com do it. So with that, one can do like a little bit of algebra to put together the pieces and model, okay, at the end, this is the percentage improvement in value that I can have if I purchase this building potentially, or like the potential. You may have to put like renovation work, etc. That's hard to determine what the amount of it would be. But again, it's you can do preliminary it's like if you think about if you're given a deal and you have its income expense sheet and you try to gauge, is it under, sort of does have value add potential? Well, you're not going to have the income expense sheets for 1,000 buildings or tens of thousands of buildings, let's say, but you can have a preliminary look into them through this approach, preliminary modeling, like through rental listings data. And so even though it's not going to be perfectly accurate, you will be able this way to like study many, and then you can direct your maybe like direct mail campaigns according to this and et cetera. So this is another example of kind of modeling and like data-driven investing thing. On the market side, that would be, kind of regression analysis for markets, and just really not, I would say, not what many syndicators, for example, do, or investors in general, where they would, they just pick, in the sense when they're interested in like growing markets, let's say, and they would pick like, this is like job growth and population growth, etc., and sort of back reason, that's a great market or something like this. But it's more like, actually looking at all the data, having like 3,000 counties in the US, looking at really, is this a strong market, and like making maybe your own projections, and etc. So that's a more data-driven approach. And another thing on the market side is having downside risk predictors. So downside risk predictors is something I talk about a lot, because so that's knowing market valuation. Market valuation in real estate is easy. It's not the stock market. You don't have S&P 500, which is driven by the top 5 tech stocks at the moment, like Apple, Google, etc., right? Where their valuation is not super clear, or especially something like Tesla, let's say, right? And so valuation in the stock market has gotten, worrier and worrier, and it's less clear. In real estate, you have, I feel, this incredible opportunity where, if you think of a private equity market where you can generate alpha, because it's a private equity market, so you can beat the public equities by whichever factor, maybe twice even, or maybe more, right? And so you have a private equity market where you can generate alpha. You can have a market advantage. And alpha, again, saying that's like if you have your returns, you have the market correlated to the market returns, let's say, and then beta is, let's say, in finance, they call it like your correlation coefficient. And then alpha is like the shifting factor, right? So that's like how much you're beating the market. So this thing in private equity where you can, you are able to have alpha, but suppose you're doing it with regards to private companies, you don't know their valuation too well. It's really difficult. So like venture capital syndicates, they have it's a difficult job, figuring out, and it's like super like human kind of factors, like picking, I guess, teams that are, they're better integrated into the community. They have like maybe more, their knowledge is better, etc. And that, but in real estate, we have this incredible thing that, we know property valuation. So it's a private equity market where the property valuation is known. So you can find mispricings and inefficiencies this way. Even like in the, so even with just purely, one way would be by using automated valuation models. And that's actually the 4th item I have on the list of like data-driven investing. That's automated valuation models. So I'm going to come to that. But again, like, so property valuation, you're able to find discrepancies this way, but also, market valuation to an extent. And that's something I'm going to talk about today, because market valuation is the current market overvalued, undervalued, and doing that, it's for every single county, maybe zip code, state, etc., based on its fundamentals, in a way that, that measure is actually predictive of downside risk. Has it been predictive of downside risk? And you have this also great situation that we had that humongous price correction preceding us past the global financial crisis, and we can use this as a back study. So we can use this as a back study. We can look at what predicted the downturns the best. Was it foreclosure rates? Was it, relative price volatility in different markets? Was it risk adjusted? Some markets are worse in risk adjusted terms, maybe, or different factors. And this, like, knowing market valuation, I think, is extremely useful, and it's going to be more and more useful in the coming years as we are progressing in the market cycle.
Yeah, Stefan, I want to ask one question, and I don't want to get on a super tangent, but Ryan and I just did an episode about this, and so it's kind of top of mind. I wonder I wonder what your perspective is on the iBuying space. So Zillow, for example. So, I would say that my impression of what Zillow was doing, and obviously, just to give context, Zillow has recently stopped their iBuying, whatever excursion. I kind of assume that what Zillow was doing is not completely different from what you're describing in a sense, right? They have a ton of data. They're sort of looking for arbitrage, mispriced assets. They don't want to do any work to these properties. I guess their approach is maybe a little bit more limited, but the kind of chatter online is that, oh, well, that approach is just flawed, like full stop. And I wonder how you would respond to that given what you're saying.
Yeah. And so that's that's a great question actually. So iBuying is really automated valuation models. That's what it's based on. So it's kind of like this fourth item that I'm sharing today, right? So that's what kind of supports the industry, or like this kind of sub industry call it. But then the thing is that with iBuying now, I don't know their business decisions. I don't know, like specifically for Zillow, why that became an issue, let's say relative to Open Door or some of the other players in the space and what they did, etc. Because I mean, purely like the concept of like having like some kind of automated valuation is a preliminary, metric where everybody knows that, okay, that's not going to be accurate in all cases, and etc. And it's you need if you're taking actual business decisions, you do typically need something more than that. So that's I think is known. So like what in their business decision made them want to scale to a point, and it's kind of like it's a big organization. I don't know what were the incentives of all the like management there, etc. And so I'm not aware, but as far as let's say their tech, let's say like their Zestimate, let's say, like, I mean, I'm sure you guys have seen their Zestimate often being kind of off.
Right.
So that's a difficult thing. And I listened to their CEO before, actually before the iBuying thing happens, pretty recently before that, and he was sharing, like it's really difficult to value houses. It's a challenging thing. It's a challenging thing, and especially single family houses, which have like lots of different parameters, etc. So again, that's not, I think, as far as what business application should be done on top of this technology is an important question or a different question. But to me, like the case where you can have preliminary analysis done for you, where you would further dig into it later, but you still have like this kind of preliminary information is just very valuable because it allows you to scale. Let's say, what is the alternative? Like the alternative is you don't have it. And then if you don't have it, you're not going to preliminarily study 1,000 buildings. Now, It's kind of like a missing piece of information. Now, so that's just kind of my perspective, but definitely like the Zillow tale, has been a kind of a cautionary tale to AVM, and it's true. And another thing is, because like the first part we spoke about, like about let's say underwriting listings, that doesn't most of the time rely on AVM per se, unless you want to find like price inefficiency specifically. But if you most of the time you do more like, okay, you're underwriting, like computing like the cap rates or whatever, like what's going to be based on your financing, your cash on cash and etc. on different deals. And so this kind of automated underwriting, or let's say the commercial example that I gave, which is also really automated underwriting for off-market commercial multifamily. And so that is also facilitated by another technology, which is, for example, computer vision and NLP are super useful there. Because I feel like the main thing in automated underwriting is, okay, everybody can pull data and like run some calculations on them. But then the real challenge is then where the human factor comes in is, okay, you want to look at the images of those properties, or you want to read the descriptions, right? So one wants to automate intelligence to have true automated underwriting. And that's where I believe is one of the most useful applications of machine learning to real estate, which is image kind of condition scoring, like condition scoring via computer vision. And so there is a company in New York called Foxy AI, and I'm not associated with them, but they have a product for condition scoring for real estate images. And so They have their computer vision algorithm and they do that. And then similar thing can be done purely on the textual side, which, it kind of looks less fancy, but in reality, it can be super useful because one can screen through thousands of real estate listing descriptions and sort of textually classify them on various things, be it what their condition is or even other information that one wants to extract. So that's another application.
And the idea with these types of technologies is that through AI, you could look at a building, or you can feed photos of a building or videos of a building into the platform, and it would say, okay, or it can determine this is a Class A building, this is a Class C building, this has X type of finishes, this is Y type of finishes, and therefore it should be on the higher end or the lower end of rents.
Yes, correct. Well, because for example, let's say if one wanted to let's say we stick to the residential kind of like small multifamily or single family space, and let's say we want to we want to do our underwriting for those buildings, but let's say you're determining if that building has some discount relative to a value, or if even like what its cap rate is going to be, and so you need to know condition, right? Or let's say you want to put like a renovation estimate or budget and all those things. And so you might end up seeing a lot of, on one side, it's challenging to do this because it's going to be done correctly. But then if you actually look at, let's say, Foxy AI's condition scoring for images, I tested like some of my private properties with them, and it's actually kind of aligning with my intuition, it seems pretty good. So if that becomes the case that it aligns with your intuition, well, then you don't need to do it manually. You don't need to, you will ultimately do it manually before taking your business decision. And I think one should, but at least you wouldn't have to do it for thousands of them, or like 10,000 or something like that. So
it strikes me that for a lot of what you've described, the real use case, at least today, for modeling and these like data-driven approaches is to serve almost as like a filter or a screening tool, so that you can say parse through 5,000 listings and hone in on maybe the 50 that you should focus on, as opposed to trying to manually go through 5,000 listings and one by one ask the question, is this one worth looking into further?
I think to an extent it is, yes, to an extent, because so that your ultimate business decisions be taken later in a kind of maybe in a human way, right? And plus there can be a lot of inaccuracies in the data. Let's say if you pick, even if you are, let's say you are fed, you want to underwrite a commercial property and you are given the income expense sheet, we know that a lot of that, very often that information may be inaccurate, like just the seller is giving numbers that are not reasonable, or there's certain omissions or etc. So there's, a lot of, there's just flexibility to the human brain, or where we can do a lot of different tasks in a flexible way. So it's definitely not aiming to automate 100% of the process, but to your point, it gives a filter and just can change. It's a mindset. So I try to, with data-driven investing, I try to inspire people for a different mindset and kind of to investing and like a different approach. Because again, like if one takes this mindset, it just becomes a little bit different. Let's suppose you are a commercial multifamily investor out of state, and now of course there's real estate is a physical asset. You maybe want to be vertically integrated, and et cetera. But suppose you you can actually find like incredible value add deals where the rents are super under market, and that those other income components, expense components, etc. And so you now don't need to, you just have more visibility. You can look at things that are valuable, that are kind of brought to you in an automated manner, that are underwritten to a point, and which are not constraining you to kind of having this kind of limiting, now I'm working in Indianapolis, Indiana, or something like that, which there are valid reasons for that, there are valid business reasons, but sometimes one may be somewhat flexible. Maybe wants to may be able to build a new team for an amazing deal in a different state. So it's a possibility in that sense. So it's just a different mindset and opens different opportunities. It's also more work. So you kind of end up, now you're end up spending up so much time on doing that, and maybe maybe you should be doing other business functions or etc. But it's it can be valuable. I mean, what's not a data-driven approach is, for example, when people pull, like in my opinion, like when people pull, like say a Marcus and Millichap report, and the report itself is sort of based on data-driven things. Let's say it contains data, right? But that said, you're not interacting with the data. You're not actually looking into it. And typically, at least my experience is I would not get anything out of it, for like very little, and I would not have any depth or understanding of what's going on. So that in itself is not a data-driven approach, reading data-driven things from other people in an overly summarized way, let's say. And that is the truth. And, or sort of just selecting markets without considering, let's say you're selecting markets by expectation for appreciation on their population or job growth, etc., but not actually doing some kind of regression or statistical analysis for what you're actually seeing out of those parameters and relative to other markets and etc. So that's also, I would say, not data driven, but just let's just pick like a bunch of factors or maybe just back reason my market that it's why it's a great one. And yep.
I wanted to explore. So we, before this podcast, we talked a little bit, and one thing that I think is fascinating is you've done some analysis at a very broad level of market valuations, and I think that some of your analysis suggested that perhaps we are entering a bubble or whatever you want to call it. I don't know what the buzzword is for it, and I'd love to hear about your thoughts on that. I think that's relevant to a lot of investors, obviously to residential investors for certainty. So can you expound on that a little bit? I'd love to. Yeah.
Yes. So at my company RealtyQuant, so one of the things that I do is I publish market data, and the market data focus is not all just like broadly parameters, but the main thing is really valuation. So like where markets valued right now. And so I started doing it at the beginning of COVID. So my intention was, or incentive was, okay, I wanted to understand what if the market takes a downturn, what would be like which am I going to be exposed in the markets in which I am versus other markets, etc. And so what I was finding then, and I was speaking at some events, and the narrative was US real estate is fairly valued. So there were a couple of exceptions at the time. So several exceptions at the time, and that's at the beginning of COVID and stayed the same through the end of 2020. So the big pronounced exception was Idaho. So Idaho as a state, and this is just like speaking. So I have this study for 2,700 US counties, but really, let's say in terms of states, like high level discussion. So the state of Idaho was the only pronounced kind of that in strong overvalued territory, 25% overvalued at the time, and it stayed roughly at the same level through the end of the year. There are several others very well performing, states to the west and south, as we know, like growth. This market cycle in the U.S. real estate has been, pretty much the whole western half, and then a little bit to the south with Texas and Florida. And so the other like very strong markets that had gone a little bit overvalued in the range of 10 to 16% overvalued at the time were, Nevada, Arizona, Colorado, Texas, and Washington states. So that was the picture. So it was, okay, the rest of real estate is fairly valued, let's say between 0 to 10% slight overvaluation, or even many states, like states in the Northeast, like New York, New Jersey, undervalued, in fact, in the negative territory. And so when people will say, like, because you guys are, we're investors in New Jersey. So let's say in New Jersey, like people would say, oh, the market is overvalued or is too high or etc. Well, how do you know it? Like, unless you actually like take all the fundamentals, how fundamentals have grown, where fundamentals meaning income, population, housing supply, how they have developed, where is the current price, and sort of like try to find like some kind of discrepancy. And so it's not overvalued even now, in New Jersey and New York states, and it wasn't. It was in fact New Jersey as a state. This market cycle was undervalued significantly, and so this was the picture. And I was speaking about this narrative of the U.S. real estate is fairly valued, and so what happened now this year so this year, now we all, we know there's like inflation, and the people have been urging, like to buy real estate for the purpose of, hard assets in general for the purpose of inflation, right? Or hedging against inflation or benefiting from inflation and so forth. And we've heard like some of the stories of rent growth as well. So let's say, which is sort of translates to commercial real estate growth or commercial multifamily growth at least. So rent growth in Phoenix, being, I believe, above 20% year over year and things like that. And so does that necessarily mean it will be a bubble? No, one just has to measure it. So the approach, and what I saw is that, so the same states that where just Idaho was at 25%, well, Idaho jumped in the second and third quarter, kind of like gradually of this year, to 48%, and the state of Arizona jumped so like 25 to 48, and then Arizona jumped from 15 to 32, and Nevada from, I don't know, maybe 13 to 29, and so Utah 28, Colorado 22, Texas 20, and depending on which data source. So Texas and Florida, and just to give a perspective, so first of all, what is being done and like why does it matter? What does this valuation actually mean? Because so I base it on a back study of 2000. So downturns post the global financial crisis, post 2007. So what was the best predictor of those downturns? So I looked at maybe like 10 different things. Like I was looking at foreclosure rates. I was looking at like relative volatility of different regions. I was looking at, like I mentioned, call it Sharpe ratios, in fact, like risk-adjusted returns. I was looking at affordability deviations and then other factors. So the most predictive metric that I was able to find, and I worked it to like several different, a bit more advanced models, but it really works in a similar way, is affordability deviations against the moving average window were extremely predictive of downturns post the peak. So at the state level, if one takes price income ratios at the very peak in every state, and then what affordability or price income ratios have been over the past 20 years, and takes the difference of that, that's gonna show you that had 87%, if excluding the District of Columbia, let's say, which is just the big land masses call it, and slightly less. I believe 83 with the District of Columbia or something like that. So 87% for the states correlation versus the actual drops that happened in those states subsequently. And when you say the actual drops, that can be like bleeding out for 6 years. So that can be on average was 4 years of downturn between 2007 and 2011. But really, some states and they have this at the county level as well, or counties would bottom in like 2013 or even later. And so that was so that's very, very high, I think, statistically valid thing as far as that, and at the county level, then less predictive naturally. So significant, then it's seen like it's like just like much harder to predict. So like about 75% at the county level. But again, and the reason for this is because like sometimes people think, it's if like price income ratios are predicting something. It's not true actually. Or affordability. Affordability in itself does not predict downside risk. It is changes in affordability, and also when these changes in affordability are taken against the moving average window only. Because when you do that, you are kind of reflecting other parameters inherently. For example, if we have a city which is, let's say, San Francisco, and that city is developing housing shortage over time. Let's say its affordability is at 6, where home prices are 6 times incomes in San Francisco, let's say many years ago. And then now it's decades later, it's at 20. Well, so it's because housing shortage has been developing over the time. So population to housing supply ratios have been changing, and that affordability has been shifting upward. So it's just one wants to find a kind of, like an error term, if you will, that is above those fundamentals of income and housing supply and population. And so I found this to be the most predictive of downside risk. Now, if we take an example, I've read, even at the beginning of COVID, I read some articles. There is a data vendor called Atom Data Solutions that they have the best foreclosure data. So they had published like some county level study, which was showing, let's say some counties in New Jersey, for example, Sussex County, New Jersey, it has like some of the highest foreclosure rates in the country, even though it's like a decent, nice area. But it happened to have, because overall foreclosure rates are at a low point because we're at a good time in the market cycle. And so, okay, there's New Jersey is a peak state nationwide for foreclosures, at least in those market times. And it always tends to be in the top 5, and it's typically number 1 even, and etc. And so they were like looking at, okay, what's New Jersey and also Florida, and there were maybe a couple of Western markets kind of are more at risk. Well, this is not like very, I would say, statistically valid analysis, because if one looks and tries to look at foreclosure rates in advance, predicting downside, it doesn't work. It doesn't predict anything. Like you don't even need to compute correlation in this thing, because it's seeing that it's like extremely off. And so what and here, for example, the example is here, for example, New Jersey. Well, it's a high foreclosure state, but it happens to be undervalued this market cycle because the Northeast is undesirable. And New Jersey is, well, a broad list state. Now there's, Hudson County is more fairly valued and perhaps slightly overvalued now. But the whole rest of the state is pretty much undervalued. And undervalued states, past the global financial crisis, had extremely different performance from overvalued ones. So where the 4 overvalued states at the time of California, Arizona, Nevada, and Florida, so they were overvalued like 40, 50%, and they dropped in comparable terms, 40, 50%. And the undervalued states at the time, which were, for example, Texas was undervalued and North Dakota was undervalued. So Texas was 5% undervalued, and their drop was actually only 4%. So that was, to me, like extremely interesting that, okay, we have, like maybe the biggest drop in like recorded price history, let's say nationwide in the US, and nevertheless, states, now it's a little bit different for counties, but states, big land masses, big markets, quote unquote markets, which were undervalued, they actually did not drop. So their drop of 4% tied to the income drop in the US at the time. And so one can argue they didn't even drop in valuation terms. It's just that they just kind of prices fell down with incomes, but valuations really stayed the same. So people who invested in Texas at the time, they had no effect whatsoever. For example, I had Vinny Chopra at my webinar last week, and Vinny Chopra, he said he did his first multifamily syndication, purchasing an asset in Midland, Texas, I believe, in 2008. So it sounds like the worst time to buy an asset, right? Yeah. And he had a 43% IRR over 6.5 years period at this asset, where what is like one reason, associated reason, well, prices in Texas, they actually didn't drop at the time, almost at all. 4%, there was a 4% drop roughly. It's because Texas was undervalued, so he wasn't really exposed. He bought it. That was just fine, and yeah. So that's fascinating.
Oh, right.
I was just going to ask what conclusions, or I guess we've talked about some of the conclusions, but how are you changing your approach at all in light of this data, or if you were speaking to another investor seeking advice, what would you give them based on this? Is it just kind of cautionary, or?
Well, yes, it's So I am changing my approach, like big deal, because to me, okay, I want to get into commercial real estate, and so okay, I go about, let's say this year, I go, let's refresh my data and let's look at how our valuation is working right now, because it's been pretty consistent. And just to give a perspective of this, like why I define it, at least in this measure, that we entered the bubble in the second quarter of this year, is because, for 4 years, if we take the states of Florida and Texas, for 4 years, they were valued at like 8 to 10% slight overvaluation. So, and that stayed super consistent. So to whoever is running, I don't know if private equity funds do some of that. Whoever is running those things, every single quarter, you see it at 8 to 10%. Now, in the second quarter of this year, these numbers doubled. So they went to, depending on data source, if it's Federal Reserve Bank of St. Louis, they went to like 19, 20%. FHFA, they went to 17, 18%. So they kind of doubled relative to their prior level over a really short period. And so that to me is like very disturbing. So I wanted to see, okay, I was still considering at an 8-9% overvaluation to maybe invest in Florida, because I believe overvalued markets will continue doing great. So valuation is not a good predictor of appreciation, by the way. So even if you take valuations at the down point in the market, so after the declines post the global financial crisis, market valuations in certain regions, they went to like in undervalued territory. So if one looks at like this vector of valuations at the time, where did the undervalued regions perform better than others in subsequent appreciation during the market cycle? Well, not really. There was, I believe, like 12% correlation or something. There is a very slight positive correlation. Now, it's not negative, but it's really insignificant. And so valuations are not predictors of appreciation. I believe a good predictor of appreciation is if one simply takes autocorrelation in a market. So autocorrelation is like a measure of momentum, like how much the current growth this year is correlated to the last year. And that's actually probably the best, extremely simple way to gauge where appreciation is going to be. And it varies though. In some regions, autocorrelation is very low, and it's not a good approach. But if we take the state of Florida, for example, the autocorrelation is extremely high. And so let's say my consideration at the time for commercial assets was, okay, Florida is at 8-9% overvaluation, but autocorrelation, they're so high. Okay, maybe I can pick up some appreciation in Florida, of course, on an asset that the asset itself is undervalued, and invest like that. But now that the valuations actually doubled, it became a totally different story. So I was telling like some of my like investors that we know and potential partners, well, it's the time to invest in really Midwest and maybe even Northeast. And it's not an extremely exciting thing to say, but it's really in valuation terms, it's places like Indiana and Ohio and Kentucky and even Pennsylvania and New York, which are the places to invest now. Because I personally am not going to invest in a state where the state is over about 20%. Like this is a very high overvaluation. And again, like this exists at the cities level. So let's say if we take 800 city county level and sort of like map it like to cities, like approximately. And so for 800 cities with more than 50,000 population. So if some of you listen to, maybe have listened to Neil Bawa. So Neil Bawa is like a more known like data scientist, multifamily investor. So Neil Bawa, he spoke about like some of the best markets right now. And so what is the best performing city this market cycle? Well, it's Boise, Idaho. And out of like 800 cities, right? And that's actually exactly tying to my data. And by the way, the way you know if a city is well performing is you need to know valuation too, because otherwise, what is the starting point for your appreciation? You need to start at a fairly valued point. So, for example, we take, let's say, like Florida. So Florida, the prices in Florida until, let's say, the beginning of COVID, they were roughly similar to the 2007 peak, but that's just because Florida was super distorted in 2007, was super overvalued by like 50%. And so you would not know like how to properly compare appreciation if you don't start at a fairly valued point. So you need a full history of valuations even to know market strength in that sense. And so Boise, Idaho is like the best performing city in America this cycle, and it's also extremely overvalued. So I just I refreshed my data for like the third quarter of this year, and Boise is at 57% overvalued. It's an extreme bubble territory, and that's and there were examples of very strong performing cities which were not overvalued, at least at an earlier stage in the cycle, at least a year ago. So if we take Denver, Colorado, so Denver, Colorado was extremely top performing cities. So I believe in the top 100 city was maybe number 2 after Boise. So Denver, Colorado, in spite of its incredible performance, was nevertheless at 0%, was not overvalued at all. So fundamentals there in terms of income and population to housing supply ratios, call it, they apparently supported that growth. And now at this point that, with inflation, things went a little bit overboard with asset inflation, as opposed to differential asset versus wage inflation. So that went into overvalued, slightly more overvalued territory. And I believe maybe Denver is at 12% or something like that. And again, like there are regions which were less desired this cycle, they're undervalued now. So the states of New York and New Jersey, I see them at least in current data at minus 3%. So it's not to say that real estate is not everywhere in a bubble. It's to the west. It's the states of Idaho and Arizona and etc. And then I know some people, like some investors, I hear the narrative. So one narrative that I hear is, so invest in hard assets because there is inflation. Sure, but that sounds like that's like a little bit of a simplified notion, because yes, but unless that inflation leads to some kind of discrepancies where other like fundamentals don't move accordingly. So for example, if inflation leads to, as in the state of Arizona this year, in the first half of the year, prices appreciated 17% and incomes appreciated by 1%. And so this is a distortion that is actually brought by inflation. And now maybe, hopefully, that kind of settles down. So maybe like some of the current quote unquote bubble, is going to be maybe a short-term one. And, like some of the incomes afterwards catch up and we see like extremely high wage inflation or something, hopefully. So that's also possible. Also, another thing is if we have a market that is overvalued, it doesn't mean it's going to correct, because it's just let's say past the global financial crisis, we have broadly a correction scenario. So let's say I looked at about 3,000 counties at the time, let's say the data. And so let's say by some definition of what is a correction, let's say it's a certain percentage drop within a certain period, etc. And so 80% of counties in the US experienced what we can call a correction. And so it was, broadly speaking, a correction scenario at the time. Now, it doesn't mean that if, let's say, now, like some of those Western states and to the south, right, they're overvalued, it doesn't mean they're going to correct, because they can experience, for example, more stagnant growth in the future, stagnant price growth. And maybe then kind of gradually over a long period, prices catch up, in theory. Or they don't, what is actually a little bit possible in the short term now, is they don't experience stagnant price growth, but they continue growing strong, but incomes experience sort of a super growth, and some of that difference catches up, and they become more fairly valued. Now, in reality, most of the time, historically, things end up with price corrections. So that's definitely cautionary, and it's extremely informing my decision, because to me, at this point of market cycle, now we have the great opportunity at the property level, as I mentioned before, to find undervalued assets or assets that have a value add potential. Now, of course, that is protecting an investor to an extent, but do you want to have like all your effort for finding that deal wiped out by a market downturn? No, right? In that sense. And so it's so to me, like what was most informing from this back study that I did for the global financial crisis was, it's not so much to point to which markets are overvalued, as to realize that actually undervalued states and undervalued counties within those undervalued states did not experience nearly any drop. So like a drop of 4% is quite fine. So in fact, it happens over a period of several years. And there was the state of North Dakota at the time was extremely undervalued. And by the way, the state and it performed very well afterwards, the subsequent market cycle. And in fact, it's even undervalued now, and it's a well-performing state, and because it's still a relatively kind of like a Western market. And so And so the state of North Dakota experienced actually no drop in like Federal Reserve Bank of St. Louis data. So at the state level, there was like 0% drop, like prices stayed exactly the same, and then later went up and etc. So to me, like this is the value here, because I mean, if we look at like I've had a few like syndicators, I don't want to mention names at my webinar, who were around at the time, and most of them, the narrative is, they lost what they made, so they built up their net worth before that, and then it all disappeared because you're levered, you have leverage. And, as the market took, if they were in Florida or in Arizona, the market takes a huge downturn of, 50%, 40%, and you're levered. So that's pretty significant. So I believe that it's going to be the same now for people who are in unfortunately, in Idaho and Arizona and other places. So,
Stefan, yeah, this is also great information and fascinating. Let me just pivot, because I think we're nearly out of time. I want to pivot to what it is that you do now. I know that you have started your own firm essentially. I'd love to hear a little bit about that, and also how people can reach out to you if they're interested in learning more or using your services to kind of guide investment decisions or whatever they might. Can you speak to that?
Yes. So I'm looking to, so I'm switching from like residential to commercial investment, like I mentioned, and I'm looking a lot into blockchain. So I want to do like more like tokenization and kind of tied to like decentralized finance in a way. So sort of building up the new finance space in real estate, but really like using blockchain for some of that, building that investment ecosystem. So that's one thing I'm currently working on. I started a course in data-driven real estate investing. So my website is RealtyQuant.com. So the RealtyQuant.com Academy. So I have a course with Python teaching like some of the same principles. So it goes over like all the different modules, automated valuation, and everything else we discussed today. And I do publish market data that is called
RealtyQuant, QUANT, right? Just to specify. Perfect.
RealtyQuant.com. Yes, thank you, John. And yes, and I do publish market data there as well. And I do, I do feel that people should know where market valuations are now. Yeah, I feel it's extremely important, especially for people in Western markets, as I discussed. So, and it can take, it's like I said, at least what I see is we kind of just entered the bubble. So it wasn't the case before, so it's not so bad in this sense. It can take, a few years for that to maybe realize, or hopefully it doesn't realize with a correction. So I'm sure that people have time in that sense to inform their decisions, but at least it may prompt to, okay, it's not as much as selling assets in a market that's currently overvalued, because I'm sure it's going to continue doing really well until the peak. It's more actually follow those valuations. And in fact, in real estate, even the price downturns, they don't happen that super quick. Even during the global financial crisis, it takes some time. Now, I believe about 25% of the downturn happened in the first year. So that's significant, but it's not super huge. And one can kind of track it and maybe even sell his asset within the first 6 months to an extent. Yeah. In real estate, I feel it's a little bit more doable than the stock market. And so if one has like this constant tracking of where markets are going, and the other thing, it can change super quickly, because as we saw now, like over like just like Q2 and Q3, things went to double the prior levels and more than that, and just really a change in market regime. So I kind of urge people to check that out. So that's RealtyQuant.com analytics. Right. That's market data. Mm-hmm.
Thanks, Stefan. Thank you so much for being here. I think there's a tremendous amount to unpack in all that you've said, and I would love to continue the discussion in a different context or in the same context of a future episode. I just thank you so much for your perspective. I think it's fascinating.
I just bookmarked 3 different links on his website for things to look into after this. Yeah,
absolutely. Yes, we really appreciate it. If to all of you guys out there, you can reach out to Stefan through RealtyQuant.com, as he just said. If you're interested in contacting us, myself or Ryan, we always love your thoughts or feedback or comments. My email address is john, John, at libertyhudson.com.
And I'm Ryan, Ryan, at libertyhudson.com.
If you have any comments, thoughts, perspectives, please reach out. We love hearing from everybody who listens to us. If you're able to like or subscribe via the podcasting service that you are listening to this on or on YouTube, we would really appreciate that. It really helps us out a lot. And until next time, thank you guys so much for watching. We'll be back next week with a new podcast episode. And thank you again, Stefan, for being our guest today.
You're listening to the Brick by Brick Podcast.